Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer, where you get everything in our web tools along with unlimited commission-free trading for just $99 per month. It's what we've been using here, and it saved us a ton of money as we have probably racked up hundreds of dollars in commissions elsewhere, but instead, just that flat rate for us. Now, we're going to start off in our portfolio view, and we've got a ton of stuff to talk about today. There's a bunch of things that we have to do kind of for housekeeping and to sort of stay in line with the theme of what our trades have been. So I'm probably not going to do much trading or any trading on the on the show today. We're just going to go right out to talk about what we need to do, and then I will handle this stuff after we get off the air. But quick rundown. So AMD, we're holding this position. It's just because this is a very deep out of the money put spread. We made a bunch of money on the call side of a calendar strangle rather, yesterday. Do wish that we had held on to the long call because that would have been a pretty sweet gain for the day. But c'est la vie. We're going to let this ride. It's just going to go away soon. It'll just expire over the next couple days. Carnival, still bullish, still watching it go up. It's great. Little time value remaining. We're just going to let it soak that up. Not ready to roll that position. Micron is the other side of the story. We're bearish on Micron. They surged up after we placed our trade. They're sort of out of reach at this point. No point in closing it out because we're at max loss pretty much at this point. So who knows? Maybe we'll see some big movement over the next 2 weeks before they go down, and then but we're going to leave this alone as is for now. Nvidia is an interesting one because Nvidia, we opened up last Friday at 160. They dropped down to, I believe it was 130 on Monday morning, and then they've just been kind of working their way back up, and we're seeing some really nice chunks on the daily basis. They're at the point now where we're no longer at a max loss situation, so we've got until the end of next week, and if they're going to keep moving like they're moving, we might just let them run for a bit and see what happens. Yeah, because we had already written that trade entirely off. The next trade is Tesla. So I'm going to talk about this one in a little bit more depth. We'll put the pause on that for a second. And then over here we got the Exxon trade. And we've got two trades in Exxon here. These all have to be closed out today because we don't want to hold this into earnings, which is tomorrow. That's going to involve closing out a call spread here and a straddle. Both of them are going to lose money. Unfortunately, but one of the things to point out that's kind of interesting, or at least sort of worthwhile, is this trade here, the long straddle trade. If we closed out at market right now, we would lose $72. Now we bought this at the money last week. As you can see, it closed. It was a little over 71.50. We closed it. It was on the 25th. It's about a week later, and we've gotten a week of time value of holding on to it. It really hasn't budged. It went up a dollar. It's in that general area now. We only lost $72 on the overall trade, which is in this case, 72 into that about almost 500. So we lost about 15% on the trade to hold it. And the reason for that is because the implied volatility of Exxon is increasing going into its earnings. So we sort of got a little bit of a discount on the time to hold it in the event they had big news and moved one way or the other. That didn't happen, so we'll end up closing it out as well. Because we're not gonna gamble through earnings on direction for these guys, or even on volume. So that being said, there. Now coming back, like I said, I'm going to close that out. I'll probably end up legging out of it just because the liquidity doesn't look great, and we've been able to eke out a few extra cents here and there doing it. I suggest you're super careful when legging out. Don't do it if the stock is really volatile. In this case, this is a stock that's not very volatile. It kind of moves up and down a little bit throughout the day, but I don't really worry about losing too much on these options by doing that. Now, the other one to talk about is Tesla. So let's take a look at the position we're in with Tesla right now. So we opened up a calendar strangle yesterday where we were long and short. Well, basically we had the 270 puts we were short this week, long next week, and the 350 calls we were short this week, long next week. And we wanted to capitalize on the crush in volatility because we kind of assumed it would move after earnings. I know it's kind of crazy to have that opinion, but when you have a volatility at the time for the week, for the expiration was well over 100, we thought that we would see more than 29 basis points of movement the next day. So this pretty much wrecked our trade. If we had gone for the calendar straddle, we would have, I mean, we would have cashed in. It would have been an amazing gain. But unfortunately, we're kind of trying out different strategies just to illustrate how you set them up and how you trade them. And so we went in for the trade at about $900. And as of this morning, the debit was worth about $300. So we lost $600 in that trade. And then in the morning, I went and I rolled in the put and call legs, mostly just to preserve a little bit of money on it, because we've been sinking down in time value on these guys, which are both way out of the money. Our long positions are almost written off, but they do have they have a bit of value left. So we sold these just to say, like, hey, let's as the day moves on, before we get to the video, since I wanted to talk about this. And rolling it is pretty simple. Like right now, this is the chart we look at. If I was going to make another roll, I'd probably roll this put up. I'd probably roll it up into the 295 range. So next to the put I'm talking about, which is this short call for the short put for the week, I would just click the roll options, say February 1st, and then find the strike I like. I mentioned 295. So we've got 295 here. If I clicked roll, it would then model that in for me. It would tell me what the track changes are, give me an idea of what kind of credit I would expect, and then update with this yellow P&L. I don't anticipate we're going to still have a Tesla position at the end of the day. I think we're going to cut our losses and move. This is still, I can't ever recall being in a trade where I played earnings with really high volatility and saw almost nothing when it hit the ground. It's shocking to me. You would think that one side or the other, there'd be some movement, and that would have helped us out a ton. Just a bit of movement in either direction. We could have broken even if we had a 5% rise or drop, but no, we're kind of getting killed here. And a lot of that also had to do with the calendar strangle. The calendar strangle is a different type of risk than the calendar straddle. Now, the straddle is just when you have the same strike right in the middle for all four of the options, the too long, too short. And with that kind of trade, you end up with a butterfly look. You had that triangle in the middle. And the downside to that is it's very rare for you to have zero movement after the earnings comes out. But if it does happen, you capitalize. And the reason we went to the strangle was to sort of illustrate how it was done, but also to say, of all the stocks we've traded earnings on, this was the one that I assumed was going to have a big move. I never would have anticipated it. But again, that's why we hedge our trades. That's why we size the positions relatively small. In this case, this was a pretty substantial thing, because that, this $600 loss we're going to write off against the book. I mean, that's almost 3%. I mean, we were up almost 2% on the portfolio as of yesterday, and then this knocked us right into the red. So there's that. And that's kind of the key things I wanted to talk about today, was in terms of reviewing the portfolio. There is one position I want to get back into, which is Microsoft. We sat out earnings. We didn't know what was going to happen. I'm very bullish on the stock, but I was afraid that maybe it would see a drop. So I just want to look at the next monthlies. They happen to be before the dividend, which I like. I'm just going to look at something slightly in the money. In this case, the 105 puts. I'm just going to grab them, say I want to do a secured put, not go through the search or anything. I know what I want to trade, send it to the ticket, and then I'll ask for 225, see if we can't get a little extra coin as the day goes on, and then I will probably come back and try to close this down, or fill it out for sure by the end of the day. Worst case scenario for an order like this is, in the event that the trade is out there and we get assigned, we'll own it around here if we're in the money, and then we've got the dividend coming right up after that. So we'll just sell a call a little further out with the dividend in mind, and then try to roll some more cash on it. The one other thing I was thinking about is just to do another earnings trade, since we are kind of in the mix of it. I realize we want to get lower earnings crushes. The earnings crush plays in. It's actually an important factor as well, because the lower your earnings crush rate is, that means that the more that the market is pricing it basically tells you the earnings crush rate in combination with our long-term mean volatility, which is just an average of the long-term mean IVs. That gives you an idea of the relative valuation of the weekly options for this week versus the weekly options for next week. And so if I get rid of the liquidity filter here, just for a moment, and then I'm going to sort by the crush rate and say I want to see, let me see here, that was the highest. Now we want to sort upward to get the lowest crush rate first. There's a few here. Now nobody has no liquidity, but some of them have fair liquidity or poor liquidity. Um, I I'm much more inclined to trade uh, in this situation. The only problem with this trade is that the volatility is really low to begin with, and so if we take a look at McKesson, and this is one of the risks that we run, is I don't really know this stock, so I'm not going to actually trade with it. But if we were to take this earnings, as we can see, the earnings richness is actually not too high. So I'm going to skip. I'm going to walk back out of these guys and take a look at. I saw Symantec on here. Let's take a look at Symantec because I did see Symantec earlier today, and it's showing a ton of richness, and it's showing a pretty good crush rate of below 50%. So what that should tell us is that we should be able to get an edge here if we sell these options and we buy these options. Now, it remains to be seen how much of an edge, and of course, we are at the mercy of what kind of movement they have. But if we just take a look at what we have here, if I select that first option series, I'm going to find at the money. So right now they're about 21. I'm going to say I want to sell a straddle, and we're going to put it into our current holdings book. That should be the only thing in the book right now. Good. Then I'm going to use the back button to go back, and I'm now looking at that same trade, which is the straddle for the first. And I say I want to see a short straddle for the 8th, so I just change the time horizon. And then instead of the short straddle, I'd be hedging it with a long straddle. So I'm going to click invert this strategy to make all my sells buys. And so now I've got what is a long straddle position I'm looking at. Now if we take a look at the long straddle, you'll see the break even for this guy is about, or actually we can see down here at 1877 and 23.23. So we're looking at in this case, you know, it would be, you can calculate that pretty easily by just taking a look at the cost of the 223 a share versus the $21 it's trading at. But the important thing is that 223 number. Keep that in mind because that's plus or minus $2.23 is a way a lot of people price these options or price the break even for an expected move. So if you were to buy the at the money, and I'm sorry, that was a little misleading there. Let me walk back on that. We're gonna put a pin in this right now. If we took a look at this week, right, the February 1st, which is tomorrow, for something who's trading, they're announcing either I believe it's after market today or before market tomorrow, and we bought this straddle, we would pay $2.05 at market rate, which means that at a market rate we would break even if it went up or down more at $2.05. If it doesn't move that much, we lose money. If it goes more, we gain money. Pretty straightforward. And so that's sort of like a quick and dirty way of what's the expected move. And in this case, $2.05 against a $21 stock tells you that they're being priced at about plus or minus 10%. Now, at the same time, we have implied volatility here that's showing for this expiration, it's 156%. So when you break down all the details and you take that and make it a periodic volatility for between now and the end of the day tomorrow, the pricing for all the options in the chain is telling you either an 11% drop or a 12% gain is sort of the expected move based on implied volatility. So again, those are, you know, they're off by a little bit, but they're relatively close. What we would like to do is we would like to see ourselves get a gain in that window. So if we go to Symantec, and I'm going to see to manage the book. So now we've got all our options collected, our long straddle and our short straddle. At this point, we have a trade here that would look to break even at either an 11% drop or in this case about a 13% gain. Now this is based on a bunch of modeling that we're sort of betting against here because we think we can do better because the crush rate indicates there's a big difference between what it's going to crush to and what the long-term volatility is. So as far as we're concerned, really, when the market opens tomorrow, if we have these, if we sell this straddle at the money, unless it's trading really close to the money, those weekly options we're short are going to be somewhere down here on the slope on one side or the other. And that's actually pretty good because it means that the one that's, if it goes up, then the put's going to be pretty much worthless. but the call will be worth something, but it'll be worth its intrinsic value or very close to it. Whereas our hope is that the put or the call that we're long retains more intrinsic value. I'm sorry, retains more time value so that it has a bigger opportunity to gain. Now, another thing that's really good to look at here is if you look at the February 1st versus the February 8th, right, you see that the spread is so close that it actually overlaps, which means that if you wanted to sell the call for next week and buy the call for this week, the spread is so wide right now that it's almost the same price. Like the midpoints on these trades means it would be 96 cents right now. You'd get 96 if you sold this at the midpoint, and you'd get, actually it's a little over $1. It would be $1.02 here if you were to, or $1.03. So it's 7 cents difference, which means that we're basically paying 7 cents of value for next week's, to hold next week's call versus this week's call. And it's pretty similar on the other side. So if we look at the track changes, it says 39 here, which would be a 39-cent premium for us to pay. But if we go to the trade ticket and we check out the, the net debit is at 16 cents. So what that ultimately breaks down to is, because the intrinsic values will line up for all of these trades, so you won't gain any money on delta as an investor here. What you're going to see is for every dollar the stock goes up, you're going to gain, intrinsically $1 for this call. You're going to lose $1 on this call, but you'll basically gain $1 on this call, and vice versa if it drops down, this put versus this put. So what this trade is really about is saying that when all the time value for this week goes away, that there will be enough time value remaining. And the question, as far as we're trading, is assuming the time value goes to 0, will the time value remaining on next week's straddle be at least 15%, or in this case, whatever we could actually close it out at? 40% might be tough to get, but 15%, that's very realistic. So I have very low expectations of being able to fill this at this price. I will dangle it out there. Actually, let's just go ahead and let's ratchet it up to I don't know, if we did by 10 it gets us 150. Let's go by 30. Let's get us up to a good size trade. Now the other problem with this is that the spreads are like this going into earnings. The spreads are going to be pretty terrible after earnings. So you know what, maybe let's just go down to 20. We'll make it a little bit of a smaller bet here at the 15. We'll price it out for that. So 300. And it'll sit. I don't know what it's going to take to fill this. For now, we'll just kind of ignore it, and I'll come back to it and deal with it after we close out. But that's about it for today. I'm not going to spend a lot of time going into the details of closing these positions. You can see we actually got our Microsoft fill. It looks like it dropped a little bit. We got it closed at 225, which we're happy with. We are down on the trade a little bit, but again, we're holding this for we're holding it with the downside of acquiring stock that we want to own anyway. So I don't anticipate it dropping 10%. That would be a huge disappointment. But with the earnings cleared up, I think that this was a nice safe bet to gain a little bit of cash and hopefully own some stock down the road if we don't own it sooner. And as always, if you have any questions, go ahead and leave us a comment below or hit us up at hello@quantcha.com. And as always, good luck and good hunting.